Have you ever stopped to think about where money comes from? It's a question that might seem simple, but it takes us on a fascinating journey through time and civilization. Money, as we know it today, was not always the medium of exchange. In fact, its birth was a result of a long and complex evolution. Before the concept of money was introduced, people engaged in what is known as barter trade. This was a system where goods were directly exchanged for other goods. For instance, a farmer who grew apples could exchange a bushel for a pair of shoes from a shoemaker. However, the barter system had its limitations. It was a system riddled with complexities and inefficiencies, primarily because it relied on the double coincidence of wants. This meant that trade could only occur if two parties desired what the other had to offer. As societies grew more complex, the need for a more efficient medium of exchange became evident. This led to the birth of money. The first forms of money were not the paper notes or metal coins we're familiar with today, but rather objects of value such as shells, beads, and even livestock. Over time, these forms evolved into metal coins and later paper currency. But who decided what could be used as money? The answer to that lies in the establishment of central banks. These institutions were tasked with the responsibility of issuing currency, regulating its supply, and maintaining its value. The first central bank, the Bank of England, was established in the late 17th century, marking a significant milestone in the evolution of money. Today, central banks across the globe continue to play a crucial role in creating and controlling money. They use a variety of tools and mechanisms to ensure the smooth functioning of economies, from setting interest rates to managing inflation. So, the birth of money was a turning point in our civilization, but how does new money come into existence today? Well, that's a tale for the next scene. Stay tuned. In our modern economy, central banks play a pivotal role in creating money. These institutions, often government-owned and operated, are the heart of the financial system, pumping the lifeblood of currency throughout the economy. But how exactly do they do this? Let's start with the most tangible form of money, physical cash. Central banks are responsible for printing and minting all the banknotes and coins in circulation. This is a delicate process, balancing the need for enough currency to facilitate transactions with the risk of printing too much and causing inflation. But in today's digital age, physical cash is just the tip of the iceberg. The majority of money in circulation exists in digital form, and it's here that central banks really flex their muscles. Through a process known as open market operations, central banks buy and sell government bonds. When a central bank purchases these bonds, they pay for them by creating new digital money and adding it to the seller's bank account. In essence, they're creating money out of thin air. Another method central banks use to control the money supply is by adjusting the interest rates. When they lower the rates, borrowing becomes cheaper, encouraging banks to lend more, and thus increasing the amount of money circulating in the economy. Conversely, when the central bank raises the rates, borrowing becomes more expensive, reducing the amount of money in circulation. Additionally, central banks can adjust the reserve requirement, the minimum amount that commercial banks must hold in reserve. Lowering this requirement allows banks to lend out more money, effectively creating more currency. This might sound like a lot of power for one institution to hold, and it is. But it's crucial to remember that these actions are not taken lightly. Central banks are guided by economic theory and data, and their primary goal is to maintain stability in the economy. While central banks have a significant role, there's another player in the money creation process: commercial banks. Commercial banks, yes, the ones you and I use for our everyday banking, are also money creators. Now you might be wondering, how do they do this? Well, it's not as if they have a printing press in the back room churning out banknotes. No, their method is much subtler, and it all revolves around lending and something called the fractional reserve banking system. Let's imagine that you deposit £100 into your bank account. The bank doesn't just put that money in a vault and leave it there until you want to take it out. Instead, they keep a small fraction of it, say £10, as a reserve. The rest, £90, they can lend out to other customers. This is the essence of fractional reserve banking. Now let's say the person who borrowed that £90 pays a builder to fix their house. The builder then deposits that £90 in their bank account. The bank keeps a fraction of it, say £9, as a reserve, and lends out the rest, £81. This process repeats over and over again, each time creating new money out of thin air. This is where the concept of the money multiplier comes in. The money multiplier is essentially the amount of money that can be created from an initial deposit. In our example, if the reserve ratio is 10%, the money multiplier would be 10. This means that a £100 deposit can ultimately lead to £1,000 of new money. But remember, this new money isn't physical cash. It's electronic, existing only as numbers in a computer system. But for all intents and purposes, it's real money that can be spent and saved, invested and earned. So commercial banks can create money not by printing it, but by lending it. Intriguing, isn't it? With all this money creation, one might wonder, are there any checks and balances? Indeed, the process isn't as unchecked as one might think. There are several mechanisms in place to control money creation, ensuring that our economy remains stable and balanced. Firstly, we have what's known as reserve requirements. These are rules set by central banks which dictate the minimum amount of cash that commercial banks must hold in reserve against deposits made by their customers. This prevents banks from lending out every single penny they receive, ensuring that there's always a safety buffer in case of unexpected events. Then, we have interest rates, a tool that central banks wield with dexterity. By adjusting these rates, central banks can influence the amount of money in circulation. When interest rates are high, borrowing becomes more expensive, which can slow down money creation. Conversely, when interest rates are low, borrowing becomes cheaper, potentially spurring more money creation. It's a delicate balancing act that requires careful monitoring and adjustment. Lastly, we come to monetary policy. This is the big picture strategy that central banks use to control money supply and demand. It involves using tools like reserve requirements and interest rates, as well as others like open market operations, where the central bank buys or sells government bonds to influence the amount of money in the economy. These mechanisms work together like a well-oiled machine, each playing its part to keep the economy stable. They help prevent situations like hyperinflation, where too much money chases too few goods, and deflation, where there's not enough money in circulation, stifling economic growth. So, to answer the question we started with, yes, there are checks and balances in money creation. It's not a Wild West scenario where anything goes. Instead, it's a carefully regulated process with central banks keeping a watchful eye on the money supply. So, money creation isn't a free-for-all. There are systems in place to keep it in check. It's been quite a journey, hasn't it? From the birth of money to how it's created today. We've traveled from the time when money was tangible, like gold and silver coins, to the present day where it exists primarily as numbers on a screen. A fascinating transformation indeed. Let's take a step back and revisit some of the main points. Central banks, those powerful institutions, play a critical role in the creation of money. They inject money into the economy through open market operations, buying government bonds, and thereby increasing the money supply. But it doesn't stop there. Commercial banks, the ones we're most familiar with, have their own part to play. They create money every time they issue a loan. Yes, you heard that right. When you borrow money from a bank, you're not getting someone else's savings. Instead, the bank is, in effect, creating new money. This is the principle of fractional reserve banking. But what prevents these banks from going on a money-creating spree? That's where the checks and balances come into play. Central banks impose reserve requirements, meaning commercial banks must hold a certain portion of their deposits as reserves. This acts as a brake on how much money they can create. Moreover, there's the interest rate, another tool in the central bank's arsenal. By adjusting this rate, the central bank can influence the desire of people to borrow, thereby controlling the money creation process. And let's not forget about us, the public. Our confidence in the banking system and the value of money is crucial. If that confidence wavers, the whole system could come crashing down. So next time you hold a banknote or see your bank balance, ponder over the fascinating process that brought that money into existence.